Welcome all to update on hybrid funds. For the last 1 year, markets have been largely flattish or range bound since the September 24 peak. It has been almost now 15 months of sideways movement. And the story is not different between the large cap, mid cap, and small cap. Within that, I think large cap has done slightly better. One of the reason I would say for markets being sideways is the weak corporate earnings, and the weak corporate earnings are largely driven by some disappointment on the consumption front. So I think this will be the sixth quarter of a single digit earnings growth for Nifty 50 companies. So if you look at third quarter till now, around 31 companies of Nifty 50 are reported, and again we are seeing a 7% earnings growth. But what has changed in the last 12 months is that both government and RBI have done multiple reforms so as to boost consumption. So it started with Indian government last year giving tax benefits. Then there was GST cut which happened. From the RBI front, we saw a meaningful reduction in the repo rates. At the same time, they also boosted liquidity. So I think versus a single digit earnings growth which we are seeing now, the Bloomberg consensus estimate indicates that we are looking forward to a double digit earnings growth in FY 27 and 28. And this, if you couple with valuation, so on a 1 year forward basis, Nifty 50 is now trading at less than 20 times, which is largely similar or lower than 10-year average. So to that extent, I think the last 12-15 months of sideways market or time correction coupled with earnings growth going forward. At the same time, ROEs of India corporate now is upwards of 15-16%. So I think net equity outlook, and we remain constructive on the equity front. On the debt front, what we have done over the last few months, we have moved some portion from G-Secs to high yield corporate bonds. And I think modified duration has been reduced slightly and now is a bit lower than 3%. But net on the debt front, our outlook remains constructive and we are positive on that side. So coming to commodities, as you know, it's part of a multi-asset allocation fund, and primarily it is through gold and silver. Particularly in the last few days, as you know, the way things have been volatile. So the precious metal complex has now moved from the euphoria to introspection. I think within that, what we have done as a portfolio strategy, already given the sharp move. If you look at gold, it has almost more than doubled in the last 2 years. Silver, which moved almost 4x, now I think it's around 3x after the recent correction. So we have been reducing silver over the last month within our multi-asset portfolio. But on the gold side, we still believe that the risk reward is favorable and staying put on the gold allocation. Now let's move on to budget. So few headline numbers, fiscal deficit for this year was at FY26 at 4.4. Target for next year is 4.3%. We also now started to give debt to GDP numbers. So I think the target is versus 55.6% this year. Government is targeting 50% plus or minus 1% by FY31. If you look at budget math, I think it's quite reasonable. If you look at nominal GDP growth, assumption is at around 10%. Gross tax revenue assumption growth is of around 7%. Expenditure growth assumption is around 8%. Last year, as you know, the focus shifted to consumption. But this year, again, I think it was balanced. It was consumption as well as capital expenditure. So CapEx number this year moved 11.5% on a YOY basis. If you look at some of the key announcements during the budget, I think first was a big tax incentive, 20-year tax incentive for data centers. Secondly, there was also some favorable change on the buyback taxation. So to that extent, I think incrementally the corporates will be nudged to continue to do buybacks. One, I think negative, which I think is more sentimentally negative, was change on the STT. So there was an increase in the STT for derivatives instruments. So here I think, if you look at the impact of this, I mean, it will be largely on the arbitrage funds and to some extent on the equity savings, balance advantage and multi-asset. So if we were to go into the numbers, the net impact for the arbitrage fund according to our estimate could be between 20 to 40 basis point, where typically arbitrage portion is anywhere between around 80% or so. If you look at other funds, the arbitrage portion is anywhere between 15 to 25%. So the impact on other, on the other hybrid funds could be the extent of 3 to 10 basis points. So I think it's a very minimal impact if you think, and if you were to put it in the context of the relative attractiveness of these funds on the equity on the taxation basis, I think it's more of a sentimental negative than any meaningful impact according to us. Now finally, moving on to this US-India trade deal, as you know, this was much awaited. Markets had given up the hope that this could happen in the near term, but finally it happened. So on the US trade deal, I think few highlights. One, there is a meaningful reduction in terms of taxation. Now we are down from 50% to 18%. On the other side, I think we have to give 0%. But I think similar to the EU deal, I think we think that the agri products are out of it. We are yet to see the fine print of this deal. Few sectors I think which got impacted because of the deal were labor intensive sectors like textiles, gems and jewelry, ceramics. I think all these sectors will see a positive move in the coming period. I think we believe this trade deal will not only help to reboost the exports, but more importantly, I think it will also will have a positive change on the balance of payments, and to that extent will ease some pressure on the currency as well as rates. Now let's move on to hybrid funds. So as you know, we essentially have 4 hybrid funds: equity savings fund, balance advantage fund, multi-asset allocation and aggressive hybrid fund. At one extreme, we have equity savings, where typically the equity percentage is between, let's say, 38% plus or minus 5%. In between those two, we have balance advantage and multi-asset, where the equity allocation is dynamic. So for example, in the balance advantage, equity allocation can move from 30% to 80%. In multi-asset, it can move from 40% to 70%. While on the aggressive hybrid front, typically since inception, we have been maintaining 70% plus or minus 5 to 6%. I think one of the common thing in all these 4 hybrid funds, one is it has a equity taxation. Second, I think what we have done, given the investor profile who comes to the hybrid funds, which are typically who wants FD plus kind of returns, but at the same time, they don't want volatility similar to equity markets. So to that extent, the equity portion of the hybrid funds is large cap biased. At any point in time, we don't keep large cap less than 60-65%. Right now, given the attractiveness of large caps, the large cap is around 70 to 75% in each funds. So if you look at last 3-4 months, given that markets were moving up, Nifty 50 was moving up, so we were marginally reducing the equity percentage, and this was valid for all the 4 hybrid funds. But in the January month, we have changed our stance since market has corrected in the January month. So we have increased our equity allocation anywhere between 1 to 2.5% across the hybrid funds. So if you start with equity savings fund, so there we have added some weights on logistics and private banks, and reduce some weights on the materials and pharma. Coming to balance advantage fund, there we have added weights on private banks, capital markets. On the oil and gas side, while we continue to remain underweight, but we have cut our underweight stance on the oil and gas within balance advantage. If you think from the reduction point of view, the key reductions were IT, pharma, and to some extent materials, which were the reduction. Moving on to multi-asset, the sectors where we added some weights were private banks and auto ancillaries, and some weight reduction on the material side. And lastly, on hybrid, there was some weight addition on pharma, one capital market names we have added, and some addition on the auto OEM side. And if you think on the reduction on the multi-asset, we have reduced some weight in the NBFCs and utilities. I think at a broader level, we continue to remain overweight and positive on the private banks, given the credit outlook is looking better and valuations are also quite reasonable. On the pharma side, we continue to remain overweight. We had taken a contra positive call 1.5 years back, and we continue to maintain that. Consumption is one of our bigger theme within the portfolios, where typically consumption not only includes discretionary, but it also includes sectors like building materials and others. But within consumption, we are underweight FMCG primarily because of valuation. Some of the other sectors, which we have added weight, as I said, oil and gas, we have cut some underweight. On the capital market side, we have added one name, continue to remain underweight on IT and capital goods. Portfolios, if you look at last few months, have benefited from upmove in metals, in telecom, in auto, and also capital markets. So net, I think what we have done in the last few months is, have modified the equity percentage as per the market movements, and which are driven by model. As you know, for our balance advantage fund, our model is based on PE and PB. As the markets moves up, model suggests equity reduction and vice versa. So we have modified both balance advantage and multi-asset based on the model. 90 to 95% of our time, 95% of the time, we follow the model. On the multi-asset front, as I said initially, we have reduced some weight on the silver front. Net, I think we'll continue to manage these funds dynamically, and as and when market movements happen, you will see equity percentages changing within the hybrid fund. Thank you. That was the update on hybrid funds from our side. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.